Keep coming back to it, but let's also invite Jyotivardhan Jaipuria, the founder and managing director of Valentis Advisors, who joins it on the show now. Jyoti, thank you very much for joining in. The Indian markets have been extremely resilient up until now, but the macros do suggest that there are further challenges. Increasingly, most of the leading global companies are warning of profits hit on account of inflation, bleak global demand, and at some point, the economic reality of what's happening in US and Europe does filter and reflect, on what's happening in India. Do you think India's outperformance could get challenged? How would you assess the setup right now?
Yeah, so, Deepa, you're right. So to some extent, I was surprised with how resilient our market was. Like even today, the market didn't really fall as much as a lot of the Asian markets did. I think one reason for that is just, our domestic economy has been doing well and it continues to do well. If you look at like on a relative basis, probably India will be the fastest growing economy over the next, let's say, 3 to 5 years. And most people accept that globally also that this is going to be the sweet spot in terms of economy. So that is helping the Indian market. At the same time, I think some of these global challenges are going to hurt us. We had a very stable current account deficit, which now will come a bit under pressure. We will have the currency coming under pressure. So there will be challenges. The export part of the economy will start to slow down. So to that extent, I think, we need to be a little cautious at these levels.
Hi, Mr. Jaipuria. Good morning. This is Pavitra. So you said that we need to be a little bit cautious at this level. What is the kind of risk that you pencil in on the downside?
So, Pavitra, the way we've been looking at the markets, and that's the way it's played out, is this is going to be the year of consolidation. So we'll be like, plus minus single digit for the year in terms of stock market returns. So far, it's working out in that respect. It's like, I think, practically flat for the year. And so probably a bit of downside, I think we could see. But otherwise, it's a market where over the next 6 months, I see it more consolidating. And a lot of the valuation correction probably will be time correction with a bit of a downward bias.
Hi, Jyotivardhan. Morning. So a time like this would be the time to look for individual stocks, right? And therefore, how does one approach it? Do you start at the sector level and go down? And, where is your interest currently?
So, we've had one theme from the last many months, and that has been we like domestic India. We don't like things which are more exposed to the globe. So basically, whether it is software, whether it is global commodities, whether it is anything export related, we've been trying to avoid. We've been trying to buy a lot of stuff which are more domestic oriented. Some of the sectors which we've been positive on, one has been banks, which, basically we saw a cleanup for the last 3-4 years in the banking sector. So there was a sweet spot over the next 2 years where, NPL provisioning is going to be much lower. Second is credit growth is picking up, partly because of inflation, partly because the economy is starting to do well. And so, initially with rising interest rates, they have margins which go up initially, at least because, deposits reprice with a lag. So to that extent, banks has been one area we are clearly positive on. We continue to be positive. And so every dip which we get in this correction, we would be adding to the banking space. The other thing we've generally been looking at is global commodity prices had gone up a lot. We think global commodity prices are going to come down. So in that sense, any user of the global commodities which were getting hurt on margins will start to see better margins. So one sector is cement, which was hurt over the last 6-9 months. So that's one sector which we are playing. The other would be, building materials. So whether it's tiles, whether it's, cables, all of these will see strong domestic demand and margin improvement, which will come through.
What about IT? The street is still very divided because the valuations have come off. We've seen a significant amount of PED rating. It's been the worst performing sector. There are concerns about macros. But on the other hand, many people believe that the worst is still to come and things could go down south from here on. Which camp are you on?
So we've been avoiding remark. We've been avoiding IT simply because, as the things start to deteriorate globally, it's very tough to figure how bad things can be. But what you can clearly see, and if you just go back to the Fed statement yesterday, Powell was very clear. He said, I think we will get a recession, and he's okay with getting a bit of recession because he wants to kill all inflation expectation. So to that extent, global growth could, surprise us more on the downside rather than on the upside. Europe is, I think, a very, very weak spot. So both Europe and US could see economy starting to go down. And that's why I think, we could see, some pressure coming on margins, some pressure coming on top line, which we don't anticipate. The other thing is, if the US markets fall and Nasdaq falls, then basically a lot of these companies end up taking their cue from there in terms of valuation. So I think, that valuation could be the other area which could be disappointing. So even though they have fallen a lot, and so it's come on our radar simply because they underperform so much, we're still not overweighting the sector.
Okay, that is on IT. Another space that we have been discussing a lot is this entire defense pack and the kind of rally we've seen in a few of these names. There's this big government push on indigenization. Do you think there's a lot more left in this space?
Yeah, so, I think defense will be like a great theme for the next 4-5 years, simply because, the government is committed to buy more and more stuff from the domestic industry. And, so we're just scratching the surface at the moment. So, the number of players we have are limited. There are some big companies which are get to defense, which are doing well, but then, defense accounts for like 10-15% of their order book. So there are some larger public sector companies which are there, and there are some smaller private sector companies. So we are very interested in the defense space. We are looking at it, we're buying it. I think obviously in terms of share price, there'll be some challenges along the way because a lot of these orders are lumpy, and we have seen a lot of share price movement already. But this is a sector where over the next 3 years, 5 years, we'll make a lot of money. It may not be in a straight line, and maybe some of these stocks need to consolidate short term.
Okay, defense as a space is attractive. IT is an avoid. Thank you, Jyoti, for joining in. But he's still cautious in the markets as a whole. Doesn't expect big returns. Perhaps some more consolidation, maybe single-digit kind of returns from here on. We'll get into a very short break on that note. We'll come back and focus on the currency space.